The easiest way to become a millionaire is by investing your money into the stock market. But it only works if you go about it the correct way, and that's what we're going to be talking about in today's video. You take today's video to heart, you really listen to it, it could help you make hundreds of thousands of more dollars over your lifetime. Make sure you like the video, make sure you're subscribed, and we'll jump right into the content. This is why you don't panic sell your lows. This is why you don't try to time your investments, right? Oh, I'm going to sell, and then I'm going to rebuy cheaper, and then I'm going to sell, and I'm going to rebuy cheaper, and then I'm going to... Bink, and you've just missed out. You've just missed out on like a 5% move. The S&P's historical annualized return is only like 9%. It's very normal for a few key days to represent most of the annual move. Yeah. Someone did an analysis of what your returns would be if you missed like the 3 largest green days in every year, and your returns are like cut by like 80% or something ridiculous like that. And that is exactly why you don't try to time your investments. You could miss just a couple of days a year. You miss this rally, it f***s your entire year's return, you know? Oh yeah, here. So this is what you would be up. I don't know what the initial deposit is here, but it doesn't really matter. This is what you would be up if you were fully invested, $158,000. This is from 93, so this is when SPY started. If you miss the 10 best days... I'm sorry, is this just the 10 best days, or is this every year? No, I think this is literally just the 10 best days. This isn't even considering every year. If you just miss the 10 best days, you're down 54%. 20, 73, 30, 83% down. If you would like access to statistically proven trading systems, check out daytradingstrategies.net. Link at the top of the description down below. You miss 30 days out of the last 30 years, and you are down 83. You're up 83% less than you would be. You know how important it is to understand that? Never sell, I guess. Correct, yeah. Correct. Never sell. Yep. Until it is time, until you get close enough to the age of retirement that it's time for you to rotate out of stocks and into safer investments, that's when you start selling, right? That's when you start rotating out of, because the equity market is volatile. You don't want all of your money in the equity market when you're 5 years away from retirement, because there could be a multi-year pullback. We've seen it happen, obviously. So that's when you want to start selling and rotating into some safer things. So the best way to invest is actually tactically the easiest way to invest. It is to take a percentage of your monthly income or weekly, however you want to schedule it, putting it into an S&P ETF and forgetting it exists until you're 10 to 5 years away from retirement, and then rotating into some safer things. It's not complicated. It's actually the easiest way to go about it. It's the least amount of studying you need to do. But people are often incapable of doing it. Fear takes over. Whenever there's a bear market, because listen, in your next 30, 40 years of life, however long it is, however old you are watching this, you're going to go through a couple of more bear markets. It's going to happen. There's going to be recessions. There's going to be black swan events. It's going to happen. And where people screw it up and why not everyone's just a millionaire from putting their money into the market is because they want to try to time the market. They want to panic sell those events, and then they end up missing the bull rides out of them. They end up not compounding their gains. As I showed in that chart, if you just missed 10 days in the last 30 years, you're only up like 50% of what you could have been because you're not actually allowing your gains to compound. You miss a couple of days of gains, that's 3, 4, 5%. That's now no longer compounding for you. And over time, that builds and that becomes a real problem. So If anything, listen to me, if anything, bear markets and black swan events and huge market dips, it's never a time to sell. Why would you want to sell lower valuations? As long as you still believe in the companies that you own, or in this instance, if we're just buying the S&P 500, then of course you believe in the companies. So it doesn't, that part, you don't even have to think about that part. You can ignore that part. It's never a time to sell. If anything, it's time to buy. Take advantage of the better valuations that you're getting at lower prices. Take advantage of the increased buying power you essentially get because the value of each share is now cheaper. Well, Trey, what if? What if the market stops going up? What if something happens with the money flow and the S&P 500 does not go up for the next 20, 30 years? What if we go sideways? What if we come down? What if we have an extremely long bear market? What happens then? My first response to that would be it's very impossible and not worth living your life that way. What if you walk outside and a plane engine falls on you? What if you get hit by a bus walking across the street? There's always something that can happen, but you need to set up your future with what has the best probabilities of, making you a millionaire when you're ready for retirement in 30, 40 years. Once again, however old you are, right? So first off, try to get yourself to not think that way. We just spoke about in the last part how most people lack the dedication to remain in the market because they let fear take over. And that's exactly what I'm talking about. Look at what people have missed out on because they're afraid that the market's going to come down, right? But let's say it does. Let's say for the next 20 years, the market goes sideways. We're still in the year 2063. Adding 40 years was hard for me for some reason. In the year 2063, SPY, the S&P 500, is still trading at 435. Something's happened. We've gone sideways. The markets haven't gone up. Well, this whole video was useless then, right, Trey? Why did you tell me to invest my money and to never pull it out? I've not made any money. Well, your S&P ETFs still pay you dividends. And let's take this next part of this video to talk about how important dividend reinvesting growth is. So let's set the scene here. Your S&P ETFs are currently paying around a 1.5% annual dividend yield. And of course, that's going to change dependent on the stocks that are in the S&P 500, right? But it will always be around 1.5%. So I have you at $100,000 starting principal. That's what's currently in your account. And I have you contributing $12,000 a year, $1,000 a month. And I have you doing that over 30 years. And I have you, you're in a taxable account. Yes, we could test turning that off. And I also have you drip dividend reinvesting quarterly, because of course that's when the S&P 500 ETFs pay your dividends. If you don't know what drip dividend reinvesting is, as you get paid your dividends every quarter, your broker automatically takes what you get paid and rebuys shares of the whatever paid you that dividend, right? So you are immediately reinvesting the dividends. And then I have it set to no price appreciation, which is not going to happen. The S&P is going to be higher in 30 years than it is now, but we're talking even worst case scenario right now. You've invested 12,000 times 30. You've invested 360 plus the 100,000 starting. So you've invested $460,000 over the next 30 years. You still have a portfolio of $586,000. That is with the price of the S&P 500 not changing at all in the next 30 years. You've still made over $130,000, $120,000 in your worst case scenario, and you still have $586,000 because you decided to invest. Now, the annualized expected return of the S&P 500 is 9% a year. You'll sometimes see 10. Let's go with the safer option of 9% a year is what the annualized historical return is. And when you give it enough time, such as 30 years, you are more likely to end up close to what that annualized usual return is, right? It doesn't mean the S&P 500 goes up 9% every year. Of course not. That's why, as I mentioned earlier, the closer you get to retirement, the less money you probably want to have in the S&P because it can be volatile. It means you have 30% green years like 2021, and then you have 18% down years like 2022, right? But it all historically since 1993 has averaged to a 9% APY. And if we do that, you have a $3.76 million account in the end of 30 years. And that, my friends, is exactly the point of this video. I know some of you are thinking it, so we're going to touch on it here in the outro. Trey, what if SPY goes to zero? What if capitalism dies? What if the country comes to an end and the US dollar is worthless and you lose all your money? Guess what? If that's the worst case scenario, your money's useless anyway. It doesn't matter whether it was in a high yield savings account or in the stock market. So who really cares? It all points to the same outcome. So don't be too concerned about that. Maybe take a little bit, 1%, 2%, 3%, and buy yourself some silver. Protect against the worst case scenario. But I wouldn't think too hard about that as it pertains to investing, because once again, if all that happens, it's all screwed anyway. You're going to be at the same endpoint anyway. So you might as well attempt to do the right thing over the next 30 years, as I just showed. But that's going to be the video today. Hopefully you did enjoy. Hopefully it helps teach you something. Hopefully it helps show you the power of compounding interest and show you how important it is to remain disciplined in the stock market, not let fear and greed take over. Remain vigilant, make your monthly contributions, forget you own it until it's time, until you start hitting some retirement goals, until you get close to that age. And you should have yourself a pretty nice nest egg by the time you get there. If you enjoyed, please hit the like button. It really does help if you're new around here. Make sure you hit the subscribe button. I'm going to go ahead and sign out of this video, but I'm going to link you all to a video here in which I talk about whether or not I think day trading is profitable.